Westpac outpaced market expectations with full-year cash earnings of $4.6 billion. And unlike its rivals, its commentary was almost upbeat. To tell us more, we have Morningstar Head of Equity Research, Peter Warrens. Peter, welcome back.
Thanks, Vicky.
Peter, in a nutshell, how did Westpac do in terms of earnings performance?
Well, Westpac did very well. Cash earnings of $4.627 billion, about 4% higher than the consensus out there, but nicely right in line with our number, so we're quite happy with that. Good growth in the top line. Dividend was a little better than expected, 60 cents for the final, 116 for the full year, but a slightly elevated payout ratio of 73% versus the long-term target range of 70%. Overall, a good performance.
Peter, why did Westpac lift its dividend payout ratio?
Well, I suspect, Vicky, that they might be a little bit more confident that things have bottomed, if you like, and that bad and doubtful debts or the credit impairment charge will start coming off, and so I think that was probably that was the reason behind it. I mean, overall, as I say, it was a strong result driven by very strong growth in the top line. In other words, net interest income, and that was up 21%, and the core earnings, which is the income less the operating expenses, that was up nicely at 10%, and that's because the Australian banks and Westpac participated, got more market share than they had in 2008, and in addition to that, a very good performance on costs. Costs are only up 5%, cost to income ratio down, and that drove a nice improvement in core earnings. Now, from core earnings, we take out the impairment charge, and that, at the end of the day, was very, very high, and as expected, at up 160-odd% to almost $3.3 billion. And the increase in the impairment charge was $2.1 billion. The increase in the income was only $1.6 billion, so therefore you had an 8% fall in core cash earnings, but still in all, very, very good performance at the bottom line.
Now, you've mentioned confidence. What makes Westpac so confident?
Given that the global financial crisis, strangely enough, didn't impact too heavily on Australia, there was, a lot of, again, elevated charges for them, but what was driving the Australian banks and not so much the international banks was this very, very strong underlying performance in their traditional banking operations. You had government stimulus pushing the first homeowners, and the Westpac participated in that very, very strongly. Their mortgage growth was up 19% year on year, and 1.8 times system. The deposit growth was very strong, similar 19% and 1.4 times system. So what was happening was that there was very strong growth in the top line, and increasing percentage of their funds were coming from their customer deposits, and that allowed them to fund about 64% of all loans from customer deposits. So that was very, very efficient as well. Margins increased by about 21 points, and of course that helps if you've got volume growth plus a margin growth, then you get that explosion in the net interest income line.
Bad debts have been an issue for all of the banks. How did Westpac's bad debt provisions compare with those of NAB and ANZ, who also reported recently?
The 3 September balancing banks they're obviously comparable, but in terms of where the credit cycle was for them and the bad debt provisions, both National and ANZ took significant provisions in 2008 because they had some toxic assets on their balance sheet. Westpac didn't have those toxic assets on their balance sheet, and so their 2008 provision was lower, if you like, than the National and ANZ. So there was a bit of catch-up in 2009. So in 2009, Westpac's credit impairment charge was up over 160%, whereas ANZ National was only up about 53-54%. But it reflects what happened in 2008. In terms of the absolute number, Westpac's provision was 3.3 odd billion, and it was high, but it's going to come off from here. All the banks are going to see a reduction in the credit impairment charge going forward, and over the next 2 or 3 years, that is what's going to really drive the bottom line. There will be growth in the top line, albeit at a much more subdued rate. But what will drive the bottom line is the significant reduction in credit impairment charges.
So let's turn to the commentary by Westpac executives. There was Chief Executive Gail Kelly and Chief Financial Officer Phil Coffey. Was there any overall tone to their commentary?
Relatively upbeat, if you like, in a cautious type of way. Look, we're not out of the woods yet. We are getting out of the woods. We can actually see the green fields, out from the forest. But I think that they just want to, not to be too upbeat about it. I think both of them are a little bit concerned about what's going to happen with the regulator and what he's going to do or demand, if you like, for capital ratios going forward. And Westpac ended the year with a Tier 1 capital ratio at 8.1%, which is the lowest of the peer group, National at 9% and ANZ at 10.6%. So I can see where they want to say that the regulator shouldn't be too harsh on ratios because they're at the bottom of the pack.
So if we look at Westpac, NAB, and ANZ, who've all reported full-year results recently, was there any standout?
Well, I think Westpac's quality was a little better, but operationally they are all very sound. Because, as I say, the 4 big banks have just got so much market share because of the non-bank financial institutions, particularly in the mortgage market, fell over, and there was some withdrawal of the overseas banks that were participating in our market.
And Peter, last question. What can investors take away from all of this today?
2009 is going to be, if you like, the worst of profits and the peak of credit impairment charges. Income generation will be more subdued, but going forward, credit impairment charges will roll off quite sharply in 2011, and therefore that will drive significantly higher net cash earnings and higher dividends.
Peter, thank you for your time.
Okay, Vicky, thank you.